What's up, tax savers? So, as you have probably heard right now, we're in the middle of finalizing the election results. But one of the major outcomes so far, as of when I'm recording this, Joe Biden has been named the president-elect. And so with that comes potentially some significant tax changes come in the next year to 2 years to, and beyond. And this does depend on, kind of who wins the Senate, and there's some runoffs going on that. But a lot of people have been asking kind of and wondering and anxious to know about what does this mean for my taxes? And so I wanted to kind of break down. Biden actually, to his credit, put out a comprehensive tax plan of what his plans would be should he take office and implement like his goals for taxes. And so I want to share what that is for you, kind of break down the different like major criteria and what that means for you, what each of those things mean for you. And so let's go through that. And I've got my notes here because I have not memorized Joe Biden's tax plan. And just full disclosure, this is all subject to change. But as they come up, if you got items below or items or questions on anything that I'm sharing here, feel free to drop them in the comments below because then it will help me help you and get everything answers clarified and answered for you. So first, one of the big ones is changing the capital gains rate. So one of the proposals, he wants to change the capital gains rate to 39.6% federally. And what this means is right now it's from 0 to 20%. And the very top bracket for capital gains meaning when you sell a piece of property or an asset like a stock, is the top bracket is 20%. Each state's a little different, but these are just federal rules. It starts at 0. Almost everyone's kind of paying either 10 or 15%, and then a few people are paying 20%. This would basically eliminate the capital gains rate. So the top rate is 39.6%. And so this means if you're kind of in that, like if you have some big gains that you want to harvest and you've made a lot of money on a piece of property, the taxes aren't going to change overnight, but if you're considering selling it, doing it before the end of the year might be a good idea. Because that's a significant factor, potentially a 20% swing on any capital gain. Next, the top tax bracket's going to increase back to what it was basically pre-Trump. So right now it's 37%. It's going to go up to 39.6%. Your estate taxes. So right now there's a tax-free portion, and this isn't. This is the tax that you pay on the total value of whatever you pass on to your heirs. So if it's right now the tax-free portion is $11.4 million, meaning if you have a $10 million estate that you're passing on to your heirs, that's tax-free. And then there's a state tax in anything above $11.4 million, and it's a pretty hefty amount. That is going to get cut pretty much in half down to where the tax-free portion is $5.45 million. So I don't want to tell anyone to pass away sooner than later, but this will make a big difference on the timing of when certain relatives kick the bucket. This happened actually back in 2010. George Steinbrenner died in December, conveniently enough, right before the I don't know if it was 2010, but right around that time when the estate limitation was unlimited, it was capped at that point, and it was going to drop down to $1 million. And suddenly, George Steinbrenner died a couple weeks before that kicked in. So his family either got very lucky or there was some funny business going on there. But I'm not trying to say anything negative about George Steinbrenner's family. Another major piece is that Biden wants to eliminate the step up in basis related to inheritance. So right now, if let's say I've got a $1 million piece of property that I bought for $500,000 and I die and I pass it on to my kids, they get a step up in basis to whatever the fair market value is when I die on the date of death. and they're looking at eliminating that. So essentially, if my heirs inherit that $1 million piece of property and then sell it 2 weeks after I die, they get all of that money tax-free right now. With this elimination of a step up in basis, if I had bought it for $500,000, that's what their tax basis would be for capital gains calculations. So if it's worth $1 million and then they sell it 2 weeks after I die for $1 million, they pay tax on $500,000 on top of the estate tax. And so that's going to be a major change potentially if that goes through for anyone who's receiving an inheritance. Again, not advocating Kevorkian methods of medical practice. Social Security is going to change in that. So right now it caps at a certain level, and then anything above that, it's just done. What they're looking at doing, you've heard Joe Biden say a lot. No one who makes less than $400,000 is going to see an increase in tax. So how this is going to work on the Social Security side is right now you pay Social Security taxes on the first $137,700 of your wage this year in 2020. That's going to still cap and stop. And then you pick it up again after $400,000. So you don't have Social Security withholdings on the amounts between $138,000 and $400,000. But then on the amounts above $400,000, you're going to see that 12.4% of Social Security tax kick back in. So those of you who have maybe $1 million W-2, some of these Silicon Valley executives and high earning executives are going to see a pretty significant chunk out of your take home if that ends up going through. Audit rates. Everyone loves to get audited, right? So right now we're looking at, they did some analysis saying that if they increased audits, that there's probably a potential $535 billion in taxes that could be brought in if we increase audits back to their level of 10 years ago, and then trained its focus on the super rich. So I don't know what the definition of super rich is, but my guess is it's anyone over 400,000 of income. And so that is so it's looking at reinvesting in more auditors in the IRS, which actually from a business decision for the IRS makes a lot of sense. Because if you think about it, if you laid off if you're in the business, if you were a sales team, like your company was a service business and you laid off all of your sales force, probably be hard to generate revenue growth. Well, think of auditors like the IRS's sales force. They're generating revenue growth. So that actually does make sense from a business standpoint on the IRS's side. That doesn't mean it's fun to get audited. And so just know that it's likely that you're going to see an uptick in audits in the coming years, which makes it all the more important to look at how you're doing in benchmarking against your industry and not throwing any red flags into your overall tax situation here. 401k changes. So basically they're going to change how the tax benefits work for your existing plan. So we're going to repeal the current tax deferral of traditional retirement plans like 401ks. So right now, if you max out your 401k, you get a $19,500 deduction this year. So we're going to change it, and you're going to get a tax credit. And the reason why that's the case is because right now, if you max out your 401k and you get a $19,000 deduction and you're in the top bracket, you save 37% of that. If you're in the bottom bracket, you've saved maybe 8% of that. So what they're looking at is it's a credit for how much you put away so that regardless of your tax bracket, you end up with the same benefit. Not a terrible idea, actually. And so it's to equally incentivize savers regardless of what they earn. And that credit, that proposed credit would be 26%. So a 26% credit of what you put away, no matter what your tax bracket is. So to recap so far, capital gains rates going up, which would significantly impact property prices, most likely. And then estate taxes changing significantly, Social Security taxes changing significantly, audit rates going way up, and then retirement plans changing from a deduction to a credit. We're going to see corporate taxes go back up to what they were before Trump. If you think about kind of Trump's goal was to roll back all of the Obama administration's stuff. Biden's goal is to roll back all the Trump administration's stuff. And so it's kind of this cat and mouse game of it's going to most likely on like the tax bracket side, they're rolling back to pre-Trump era. Same thing with on the personal income tax side. Same thing on the corporation tax side. And so you're going to see corporate rates go back up to what they were pre-tax reform, which those of you who switched from an S corporation back to a C corporation, which I never advocated unless you were in a very high bracket, you're stuck for 5 years. So if you just did that in the last 1 or 2 years, you may see your overall, because of double taxation, you may see your overall income tax going up. The other thing that's going to be eliminated is the $10,000 cap on state and local plus property taxes on your itemized deductions. And the reason why is because this mostly impacts those high income tax states, which mostly voted for Biden. And so because state income taxes, if you make, like in California, for example, you hit $10,000 of state income tax if you make 130 grand a year. And so you hit it pretty quick, and then there's no benefit to owning a house. And so they're going to either raise or eliminate that $10,000 cap on the itemized deductions. We're also going to see, for those of you in real estate, this is a big one. So you're going to eliminate the $25,000 exemption from the passive loss rules. So right now, if you've got passive losses, it's capped at a $25,000 deduction. They'd eliminate that, but on the other side, they're going to eliminate like-kind exchanges. So a like-kind exchange means if you've got a big gain within one of your properties, a lot of appreciation, then you can actually sell it and then buy another property to upgrade and then defer the gain. You don't pay the taxes on that. They're going to get rid of that. And that is a big strategy that a lot of people in real estate use to continue reinvesting their gains into more and more properties. And so that's going to change your investment strategy a whole lot if you're in the real estate space. Also related to the real estate space is right now we have a lot of bonus depreciation on fixtures and other improvements, meaning if you put improvements into your properties, you get 100% deduction on the cost of those in the first year. Those are going to be eliminated, and they'll be subject to just normal depreciation rules. And then looks like the qualified business income deduction. So you would limit that for only individuals who earn more than $400,000 a year. So that's an interesting one, because right now your qualified business income, this is for pass-through entities and sole proprietorships, you get a 20% deduction on the net income of your business, the profits of your business, and that starts to phase out around $300,000 or $400,000 a year. He's saying he's going to eliminate that 20% deduction for anyone under that. From my understanding of it, and this is, of course, we'll get more clarity on it as time goes by, but that 20% deduction would only be if you're earning more than $400,000 per year. So those are the highlights. Bottom line, and I said this several months ago and was going to be the case no matter who ended up in office, but you think about it, we printed over $5 trillion earlier this year, and that's got to be paid for somehow. And so we're in historically low income tax brackets, income tax rates right now, so they are going to be going up over time. If you look at the top tax bracket in the 1950s, which was about 15 years after the New Deal was put in place, which was a similar infusion of capital into the economy, the top tax bracket for federal purposes was 94%. And right now we're way lower than that at 37%. And so I don't think they're going to go up to 94% anytime soon, but they are going to be going up. So hopefully that was gave you some insights and some clarity on what you can possibly expect with the next administration. If you've got any questions, drop them in the comments below, and we'll see you next time.